Hello everyone, welcome to Easy Economics. How are you all doing? I hope you all are doing good. Well, today we are here with the second part of our topic, foreign exchange rate. We'll be beginning with what are the reasons why exchange rate fluctuates. So let's look at the reasons. The first reason why exchange rate fluctuation occurs is because of export revenue and import expenditure. So, for instance, if a government needs to pay for its import expenditure, and when it's experiencing an increase in its export revenue, so what happens? The exchange rate is automatically going to fluctuate because it's having an inflow of revenue. So, if the exports revenue is more in comparison to the import expenditure made, so what happens? The exchange rate would appreciate, right? So, why would it appreciate? Because the demand for the currency was increasing, right? Because the country had to pay less for imports, in contrary to what it was receiving by way of its exports. Since the foreigners had to pay for the exports made by the country, the demand for the country's currency has risen, causing the exchange rate to rise. Hence, again, when the exchange rate rises, what happens? In other words, the exchange rate fluctuates, right? The second reason could be foreign direct investment. So, if any foreign multinational company decides to set up a plant in your country, what would happen? The demand for your country's currency would rise, causing the currency exchange rate to fluctuate. The third reason could be that transactions are done by the government and the central bank. Now, the government and the central bank both buys and sells currencies. The government does it again for its balance of payment, for its international transactions, for exports and imports, for maintenance of its reserves. The central bank does it to restrict imports or to increase exports. Similarly, it also does by way of increasing the interest rate. And when it increases the interest rate, it's trying to do what? It's trying to get hold of hot money flows. Now notice I made a star against this term. Can anybody tell me what does we mean by this term hot money flows? And what do we actually mean by it? What is it actually? So you see, deliberately a central bank raises the rate of interest in order to raise the value of its currency. Why? Because a higher interest rate would attract hot money flows. So what are these? These are funds which are moved around the financial markets in order to take advantage of the differences in the interest rates and exchange rates. So if more people want to place money into a country's financial institutions, what would they be looking at? The interest rate. So it will increase the demand for the currency, right? In addition to this, a government may try to increase the value of its currency by finding out ways to increase its exports and reducing imports, right? So hot money flows is what? It's the movement of money around the world in order to take advantage of differences in interest rates and exchange rate. So it's done by the central bank in order to attract investments. So this would cause the demand for that currency to rise, and automatically the exchange rate is going to rise, right? Causing a fluctuation in its exchange rate. All right. Now let's look at what happens when there are changes in exchange rates. So what happens when the exchange rate changes? The first is the impact on exports and import prices. So what happens when there is an increase in the exchange rate? It would cause the price of exports to rise, and the price of imports to fall. So the price of exports is going to rise in terms of foreign currency and imports would fall in terms of domestic currency. But what happens if the export prices rises? So the export prices rises. What happened? They would get expensive relatively to imports. So when the exports get expensive, what happens? Are we able to make more exports or less exports? The country would be able to then have less exports. So then what would happen? The impact on export revenue would depend upon the price elasticity of demand. So you can't just say that when the export prices rises, so the export revenue is going to fall. It depends upon how elastic the demand is. Now, usually it's being seen that since uh, a lot of countries compete in the international market, so the demand for most goods and services is usually elastic because there are substitutes available in the international market. However, if the demand is inelastic, so then there would be little or no impact on the export revenue. But if the demand is elastic, an increase in price will cause export revenue to fall. But if the demand is inelastic, an increase in price would cause little or no effect on the export revenue. It could be that the export revenue might rise, right? Apart from export and imports, what happens because of changes in the exchange rate on the overall economy? What happens to economic growth, or let's say employment or inflation? Are these affected also? Yes. How? If exchange rates are falling, so what happens? Exports will be relatively cheaper and imports will be expensive, right? So what happens? Therefore, domestically produced goods demand would increase, right? People would switch to locally manufactured products. That's called import substitution, right? So what happens? So when domestically produced goods demand increases, the aggregate demand would increase. So when the aggregate demand increases, what happens? Employment level rises, firms would want to expand, right? The level of operations would increase, their scale of operations would rise, production facilities would expand their production. As a result, economic growth would be witnessed by the economy. The PPC would shift outwards. But this would only be possible if the country is not operating at its full capacity. That means either we have unemployed resources or we are operating inside the PPC, right? So that means we can increase the quantity and the quality of the goods and the services by utilizing those unemployed resources, right? But if the country is operating at full capacity, what's going to happen? Then the country is going to be experiencing inflation. And this rise in inflation means that the price of key imports would also rise, or the price of imported raw materials could rise. So it would add and increase the inflationary pressure, right? So then if the raw materials are a part of your manufacturing process, so it would again increase the cost of production and it would increase the price of the final product, right? So then it would happen what? It would cause the consumer price index to rise. Overall, the level of inflation would rise. All right. Now let's look at the floating exchange rate and let's look at fixed exchange rate. Let's look at the advantages and disadvantages of a floating versus a fixed exchange rate. So by definition, floating exchange rate is what? It's determined by the market forces. Therefore, this means what? It's automatically adjust any gaps in between the export revenue and the import expenditure, right? So this means that the government can focus on other macroeconomic aims and it does not have to worry about pegging the exchange rate within the particular band, right? So constant fluctuations, but then there is a disadvantage. These constant fluctuations create uncertainty. What happens? they create uncertainty. And as a result, what happens? Speculation or depreciation may also cause significant changes, forcing the government to intervene there. Now, what happens? On the contrary, if you've got a fixed exchange rate creates certainty because we know that the exchange rate is going to be within the prescribed band, within the prescribed limit. So, overall, investors or firms, they are certain about the exchange rate because it's being within a specified rate or range. So firms are certain about the amount they would be receiving upon their exports, and they also are sure about the amount they need to pay for their imports. But in order to maintain this exchange rate, the government has to play its part. It needs to have sufficient foreign currency reserves. It would then have to sell currencies, right? Or it needs to buy back the currency to bring it back to its original position. Remember, in the fixed exchange rate, we saw that the first two scenarios we did, and we saw it graphically as well. Or what else it could do is it would use interest rate. It would use the tool of interest rate. So a higher interest rate would mean that unemployment would rise because the firms would then be having funds. They would not be able to borrow at competitive rates, right? As a result, they would then shrink their operations. And when they would shrink their operations, this means that unemployment will rise. And when unemployment rises, economic growth falls. Aggregate demand falls. Plus, what happens? Then there would also be a loss of investor confidence because the government would be unable to maintain the set or the prescribed exchange rate. So these are the pros and the cons of floating and fixed exchange rate. Each has its own merits and demerits, right? So I hope this topic is now clear. Stay tuned, happy learning, subscribe. I'll be back with another topic.